Redfin just put out a report saying that real estate transaction volume in the United States is at its lowest level in more than a decade. And interestingly, this is exactly what the Federal Reserve Bank wanted, because if you remember, in June of 2022, Jerome Powell, who's the chairman of the Federal Reserve Bank, said this: "I'd say if you're a home buyer or a young person looking to buy a home, you need a bit of a reset." Well, we're now finally starting to see that reset in 2023, not with home prices yet. I'll talk about what would cause a change in home prices in just a minute, but we're seeing a change in transaction volume in the housing market, and this is affecting some real estate companies. For example, Redfin, one of the major real estate brokerages out there, recently put out their earnings statement, and what they said is in the last 12 months, their revenue has fallen by over 20%, which caused their stock to crash by over 20% on Friday, and they've been seeing a lot of kind of pain in their stock price because of that. But also Zillow put out their earnings statement, and what they said is that their revenues, their overall revenues, were exceeding expectations. However, the revenues from the Premier Agent Advertising Services, which is from now their residential division, that revenue declined year over year, which caused some pain to their stock price as well. And that was when the Redfin CEO came out and said, quote, "Sales volume is near rock bottom." Now, the reset that Jerome Powell was talking about was essentially leveling out supply and demand, because over the last few years, what we've had is so much demand and a little bit of supply. Now what we have is way less demand because mortgage rates are way higher, but even less supply because people don't want to sell their homes. And the reason why people don't want to sell their homes is because if you sell your home today, you're going to go out and get a 6, 7, 8% mortgage tomorrow. And that's why people don't want to sell their homes. So the question now is, what does this mean? But before we get into that, I want to give you a quick reminder that on August 15th, 2023, it is the 52nd anniversary of the dollar being taken off of the gold standard. And because of that, I'm hosting my first ever investor summit. It's completely free. It is a live investor summit where I'm going to be going over 3 things. Number 1, how our economy has changed. Number 2, how money has changed over the years. And number 3, how you can capitalize on investment opportunities in today's economy. So if you'd like to join me, it's completely free. There's going to be a ton of value in it. Just make sure you register. I got the link for you down in the description below because, well, there's a limited number of people that can actually join me live. So if you'd like to watch, I got the link for you down in the description. But if we talk about now what's causing this shift in transaction volume, demand has fallen because mortgage rates are so much higher. This one's pretty obvious. If mortgage rates fell to 3% tomorrow, you'd see a huge flood of buyers wanting to go out and buy a home. Again, which would push home prices higher. But because mortgage rates are now above 7%, you have a lot of buyers saying, I don't know if I want to buy a home right now. Maybe we'll wait it out to see what the heck is going on in the housing market. But then on the flip side, we have the supply issue. We have a limited number of supply because, number 1, builders are building, but they're also building with a lot of caution because they're concerned about where the economy is going to be in 12 months. They're concerned about where interest rates are going to be in 12 months. And if they're building a home or a subdivision or an apartment complex that's going to take 12 to 18 months to finish, that's where they don't want to take all that risk if they can't potentially make all their money back. So builders are building, but they're building cautiously, so they can't keep up with all the demand, even though demand has fallen. On the second hand, we have sellers of homes, homeowners, who are saying, well, we have a mortgage at 4.25% right now. If we sold our home, we could put some cash in our pocket, but then we'd have to go out and get a mortgage at 7.25% tomorrow, which is going to be a lot more expensive. Do we want to do that? Which is why you're seeing a lot of homeowners saying, maybe this is not the best time to sell a home. So what Jerome Powell and the Federal Reserve Bank is trying to do is they want to even out demand and supply, because the housing market has been contributing to the high inflation numbers that we've been seeing. One of the biggest factors in inflation, the head inflation numbers, is housing. And when you have such a strong demand versus supply, that then pushes home prices higher, which then creates more inflation or reports as a higher inflation number, which then gives the Federal Reserve Bank more ammunition to keep raising interest rates. So the reason why the Federal Reserve Bank has been working to raise interest rates is to cool down demand. Whereas the Fed likes to say they want to create a bit of a reset in the housing market because now they want demand and supply to meet. Now, the Fed does not want to see home prices fall. They don't want to see a deflationary event. That's not what they're looking for. What they're looking for is a disinflationary event, which is that home prices keep rising, but they don't just keep rising as fast as they were before. They want to see more slow and steady growth, more in line with wages. However, the risk that they face is that if you keep raising interest rates and demand continues to fall, and something causes supply to rise, it might not be builders because builders are struggling. It might not be people selling their homes right now because people don't want to sell a 4% mortgage to get a 7% mortgage. If something else caused supply to rise, potentially, let's just say, a slowdown in the economy happened and we saw more foreclosures. If that were to happen at a time where demand is low, that is what would cause home prices to fall. But we don't have that right now, because if somebody were to be delinquent on their payments today, and we are seeing an uptick in delinquencies, that's a fact, but it's nowhere near where we were a few years ago. If you become delinquent on your mortgage, chances are you can sell your home and go and rent and probably put some money in your pocket, because a lot of people still have equity in their homes. Have we seen home prices fall? Yes, in some pockets around the country, but we're still seeing some neighborhoods with crazy amounts of demand, making it difficult for people to want to go out and buy a home. And this is why the Federal Reserve Bank is saying, well, we might not be done raising interest rates yet, because they want to level out the demand and supply. We still have more demand than supply, which is why it's still so difficult to buy a home. And in order to combat now this excessively low demand, we have the lowest inventory of homes really in decades now. And to combat that, the Federal Reserve Bank is going to have to keep pushing demand lower. And this creates then the ripple effect concern, which is if you keep pushing up interest rates to put demand or pull demand lower, that could have other effects on the economy, such as making it more difficult for people to buy a car, making it more difficult for people to make their credit card payments, making it more difficult for businesses to go out and borrow money, making it more difficult and expensive for governments to go out and borrow money. And this is where now the Federal Reserve Bank is playing that balancing act. And what's interesting is Zillow and Redfin believe that this downward trend is going to continue. Let me read you what Zillow's CEO said during their earnings statement. They said that the downward trend may persist and that he expects a 15 to 20% year-over-year decline in industry transaction dollar volume for the third quarter of 2023. So the Zillow CEO is saying, yeah, we expect the number of sales in real estate to continue to decline because of this imbalance between supply and demand, the super low supply. And not just that, he also expects this to affect sales and sales commissions, because now we have a lot of realtors out there who rely on commissions to sell homes to get paid. And Zillow benefits when realtors are selling homes, because when realtors are selling homes, they're more likely to spend money in advertising. And where do they spend money in advertising? Well, Zillow is a place where realtors can advertise their business. And so Zillow says that they are expecting revenue to decline by 4 to 9% year over year in just the third quarter of this year. And Redfin expects their total revenue to decline by 9 to 13%. So this is where a lot of people are looking at the housing market saying, how is this going to affect us? And it's starting to now affect the real estate companies. And then the Zillow CEO went on to say this quote, "The housing market outlook continues to be frustratingly foggy. Frustratingly foggy, and we can only plan for it to take time to normalize." So the Zillow CEO is talking about his concerns, and then you also have the Redfin CEO talking about his concerns and predictions about the housing market too. What he says is that, quote, "Most economists once viewed a recession as unavoidable, and now they see it as unlikely," which is good news. What he says is, when rates come down, the housing market will be poised to grow again. So it sounds like the Redfin CEO, who is part of this brokerage business, right? The real estate brokerage industry relies on people buying and selling homes. And what Redfin CEO is saying, we essentially can't wait for interest rates to get cut by the Federal Reserve Bank. And it's good news now that the Federal Reserve Bank is saying that this recession is not going to happen. So the Redfin CEO is saying, hey, our economy is great. And because our economy is great, it is going to allow the Federal Reserve Bank to start cutting interest rates sooner rather than later. And once the Federal Reserve Bank starts cutting interest rates, the housing market's going to be able to grow and Redfin's going to be able to make more money. But there's one little problem with that. What would happen now if the Fed starts cutting interest rates? Let's play this out. Remember, the Federal Reserve Bank is cutting it or raising interest rates right now for one purpose, to bring inflation down. And one of the biggest factors in the inflation numbers is the housing market. And we have seen a massive run up in housing costs, whether it's rent or buying a home over the last 24 months because of the low interest rates. So now here we are today with the Federal Reserve Bank saying that there's no recession in sight. The government saying that we're not going to see a recession. And this is where Redfin is saying, oh, that's good. That means we can just start cutting interest rates. So what does that mean? If the Federal Reserve Bank tomorrow cut interest rates and mortgage rates fell to, let's just say 3%, 4%, 5%, you pick the number, what's that going to do? Remember, we have the supply shortage here and we still have demand here. If mortgage rates get cut, where is demand going to go? Demand's going to go back up to here. But you still have this low supply of homes. Maybe that means that a seller is going to say, okay, now I am more enticed to sell my home. Maybe that means that builders are going to say, okay, I can go and build more homes. But the question is, how fast would supply grow relative to demand? Because what we've seen happen, especially for the last few years, is that the lower mortgage rates push demand higher and faster than supply. Yes, more people will be likely to sell their homes if mortgage rates are at 4% than they are today. But the question is, will we have more buyers than new sellers? And that's the question where we don't know, we can guess. But what we've seen happen over the last few years is that demand is growing faster than supply because, well, of the current state of our economy and the jobs market. Everybody has a job. Why does everybody have a job? Because of all the money printing that we did in 2020 and 2021. Businesses and people were given so much money. Businesses were given billions of dollars to go out and just do whatever they want with it. So they created new stores, they created new manufacturing plants, they created new research and development facilities, they created new offices, which means then businesses were able to create a lot of jobs. And this is where the Federal Reserve Bank is trying to cool the jobs market. They're trying to cool the labor market, which means they want to create more unemployment. So you can start to see all the dilemmas happening here. The Federal Reserve Bank is trying to kind of play this teeter-totter match game in the center where they want to cool down inflation, but they don't want to break the economy. And what Jerome Powell has said on his most recent calls is that he's not talking or thinking about cutting rates yet, but he's still considering raising rates a little bit higher. So just understand what's going on. Most people who are commission-based in the real estate space, whether it's brokerages or mortgage brokers, are very hopeful that interest rates will fall because, well, mortgage rates are high. However, the consequence of cutting interest rates is that that could create an increase in demand, which could cause an increase in inflation, which could then shoot the Federal Reserve Bank's whole target in the foot because they're still trying to bring inflation down lower. So understand what's going on. We'll be covering more of this on the Investor Summit and different ways that you can start investing your money, especially in this economy. So if you haven't registered yet, make sure you do that. And I'll also be working to keep you covered here on this channel.